All right, welcome to today's Explainer. We're jumping straight into a topic that completely separates the absolute legends from the rest of the pack. When you look at historically great traders, people like Dan Zanger, who famously pulled off an insane 29,000% return in just a single year, you'll notice they all have wildly different personalities and styles. But they share one core truth that about 95% of people just never figure out. Their success doesn't come from a secret indicator. It's definitely not some magic candlestick pattern. It is simply the pure, unadulterated math behind the markets. So today, we're breaking down that exact mathematical blueprint.
To get us rolling, I want you to honestly answer a quick question for me. If I came to you right now and offered you a trading system that wins 80% of the time, would you take it? Let's be real, it's human nature, right? We all desperately want to be right. Most people would practically scream, "Yes, take my money right now." I mean, an 80% win rate sounds like an absolute dream setup. It taps right into our deep psychological desire for certainty.
But what if I told you that taking 100 trades with this specific 80% win rate system will actually guarantee you lose $1,200? Yeah, it's a massive reality check. You're probably wondering how that's even mathematically possible. Well, it's because your win rate is really only half the story. Judging any strategy solely by how often it wins is a massive trap, and it's exactly what keeps countless people stuck in this endless cycle of bleeding capital. Okay, let's dive into exactly why that happens, because this brings us to literally the single most important number you will ever need to know: expectancy. Expectancy is basically the ultimate master metric for any strategy. It tells you the average amount of money you can mathematically expect to win or lose on every single trade over the long haul. At the end of the day, it doesn't really matter how often you win. What actually pays the bills is the mathematical weight of your wins compared to your losses. And this brilliantly illustrates exactly how our 80% win rate system is quietly destroying your account. Sure, you're winning 80% of the time, which feels amazing, but you're only scraping by with tiny $10 games. Then the 20% of the time that you do lose, you're getting slammed for a whopping $100. When you combine those two realities, your expectancy is actually a negative $12 per trade. Take 100 trades and boom, you are practically guaranteed to be down around $1,200. Those tiny little paper-cut gains are just completely wiped out by devastating losses. Having a negative expectancy system with a high win rate is literally like being a world-class chef who occasionally, burns down the entire house. Sure, 8 out of 10 nights, you are serving up this incredible 5-star meal. Everyone is thrilled. But those other 2 nights, you're out on the lawn calling the fire department because the kitchen is fully engulfed in flames. A high win rate means absolutely nothing if your house burns down in the process. So the crucial point here is that the market essentially forces you into a mathematical trade-off. You just cannot have both an insanely high win rate and a massive risk-to-reward ratio. Take mean reversion versus trend following, for example. Mean reversion grabs quick, small profits, so your win rate is naturally high, maybe 60 or 70%. But your risk to reward is pretty poor. Trend following is the exact opposite. You're dealing with a surprisingly low win rate, maybe 35 to 45%, which means you are literally wrong more often than you are right. It can feel absolutely terrible in the short term. But when you do finally catch that trend, the payoff is absolutely massive, covering all those previous small losses with plenty of room to spare. But listen, understanding expectancy is really only Act 1. Now we need to talk about the survival mechanism, because here's the harsh truth. Even if you have a mathematically flawless system with a beautifully positive expectancy, it is completely useless if you don't survive long enough to actually see the math play out. You absolutely need risk management to protect your downside. To really show you why, let's look at a classic tale of 2 traders. We've got aggressive John and conservative Sally. They are starting with the exact same metrics. Both have a $10,000 account. Both trade a system with a 50% win rate, and both have a brilliant 1 to 3 risk-to-reward ratio, meaning when they win, they make 3 times whatever they risked. The system is great, highly positive expectancy. The only difference? John aggressively risks $5,000 per trade, while Sally conservatively risks just $100. Now, what happens when they hit a totally normal streak of bad luck? We've all been there. Both traders hit 5 losses in a row, followed immediately by 5 wins. John's first trade loses $5,000. His second trade loses $5,000. And well, he's done. He is completely bankrupt, wiped out before he even gets a chance to see that winning streak. His account is at absolute zero. But Sally, she only risked $100 a trade. Those first 5 losses only cost her $500. She easily survives the drawdown. Then she hits her 5 winning trades. Because of her 1 to 3 risk-to-reward ratio, she makes $300 per win, totaling $1,500. Sally actually finishes with a net gain of $1,000, bringing her account up to $11,000. That's a clean 10% return. Same exact system, entirely different survival.
So how do you ensure you're a Sally and not a John? You use this exact step-by-step formula for position sizing. It's your ultimate shield against blowing up your account. Step 1 is simple. Define the exact dollar amount you're going to risk and keep it strictly between 1 and 2% of your total capital. So if you have a $20,000 account, 1% is $200. Step 2, calculate the actual number of shares you can buy. You just take that dollar risk amount and divide it by the difference between your entry price and your stop-loss price. Let's actually see that formula in action. Say you have a $100,000 account, so your absolute dollar risk is capped at $1,000. In the first scenario, you have a tight stop-loss. You enter at $100 and your stop-loss is at $90. The difference there is $10. 1,000 divided by 10 gives you an optimal size of exactly 100 shares. But what if you use a wider stop-loss down at 80? The difference is now $20. 1,000 divided by 20 mathematically demands that you only buy 50 shares. A wider stop-loss means you absolutely must buy fewer shares to ensure your absolute dollar risk never exceeds that $1,000 limit.
And this brings us to a huge rookie mistake you've got to avoid, just buying a fixed number of shares out of pure laziness. A lot of people habitually just log in and say, yeah, I'll just buy 100 shares. But 100 shares of a low volatility stock like McDonald's carries a completely different risk profile than 100 shares of a wildly volatile stock like Nvidia. Nvidia swings all over the place, which forces you to use a wider stop loss. If you stubbornly buy 100 shares of both, your risk isn't constant at all. You could easily blow right past your defined risk tolerance on the volatile stock. You have to adapt your position size every single time.
So we have the math down. We have the risk management dialed in. But what is it that breaks even the most mathematically sound traders? It's the ultimate reality check, psychological endurance. It's simply the human brain struggling to cope with probability. Consider this quick thought experiment. If you toss a completely fair coin exactly 10 times, are you genuinely guaranteed to get exactly 5 heads and 5 tails? Think about it for a second. The answer intuitively is no way. You might get 4 heads and 6 tails. You might even get 3 heads and 7 tails. It doesn't mean the coin is broken or somehow rigged against you. It just means that in the extreme short term, the results are highly random. Here's exactly how that randomness escalates and then eventually stabilizes. After just 10 tosses, you might be looking at a 40% hit rate. Your brain naturally starts panicking. But if you toss it 100 times, things get closer, maybe a 45% hit rate. And if you have the patience to toss it 1,000 times, you're going to see a hit rate right around 48, 49, or 50%. The more you repeat the action, the closer the chaotic short-term results map onto the true underlying mathematical probability. This whole concept is what we call the law of large numbers, and it is absolutely vital for your psychological endurance. When you have a proven system with positive expectancy, you cannot just abandon it because you took 6 losses out of 10 trades. Your outcome over 10 trades is basically just random noise. The law of large numbers dictates that you have to execute with immense discipline over a massive sample size. It's only over time that your positive expectancy finally pulls you out of the random noise and into sustained, reliable profit.
So let's bring all this home and recap the core structural pillars we've covered today. First up, expectancy always beats win rate. A high win rate with a negative expectancy is just going to quietly drain your account. Second, risk management ensures survival. You have to be a Sally, easily surviving those inevitable losing streaks. Third, position sizing standardizes your risk. Always calculate your shares based on your stop loss and your hard dollar risk limit. And finally, the law of large numbers requires incredible patience. Stop letting short-term randomness trick you into abandoning a mathematically sound edge.
Which leaves us with one final, vital question to think about. Are you going to keep spending your time desperately searching for that non-existent magic indicator, trying to find the perfect combination of squiggly lines on a chart? Or are you finally ready to step back, look at the cold, hard reality, and just trust the math? Because at the end of the day, the math is what builds consistency, and consistency is exactly what builds success. Thanks for joining me on this explainer. Keep those mental models sharp, and I'll catch you on the next one.